Big news out of China today. In a surprise move, that country's central bank cut interest rates. The move comes as China released a slew of data that painted a weak picture of the economy. Retail sales and industrial output, they slowed and missed estimates. Youth unemployment hit a record high, and home sales fell more than 28% year over year. Joining us now to break down the fallout is JPMorgan Chair of Global Research, Joyce Chang. Joyce, great to see you. To what degree has the degree of economic weakness been a surprise to you, or have we seen the signals coming at this point?
Well, great to be with you, Mike. I think, the Omicron is still a big problem for China. So the retail sales really disappointed. They were actually down a little bit from June to July, and that's a surprise. Now, we haven't changed the third quarter outlook, which is still that you could see a double-digit rebound after a very sharp contraction after the second quarter. But it remains to be seen how this will play out for the full course of the year. I mean, we've got China's full year growth a little bit north of 3%, but we've continued to have to take that growth number down. And it's not just Omicron. The property sector, the housing market is really a problem in China that's not going to go away anytime soon. So it was a surprise easing. And the question is, are they going to have to do more later this month? And that's what the market's going to focus on.
Right. I mean, and that surprise easing now was just maybe a gesture, right? It was 0.1% cut in rates. And what's your read on that exactly? I mean, was it essentially just, an acknowledgement of the weakness? And you say, will they have to do more? Would that be your baseline expectation now?
Yeah, I think they may have to do more policy easing, but the real question is in August, later in this month, are you going to see even more fiscal measures announced, not just policy easing? I mean, the 10 basis points was, maybe just a little move, but the fiscal measures are what the market will focus on, and really how you get the growth numbers looking better before the plenum later this year. So I think that the housing market, though, is going to continue to be a drag on the economy. And even though they've announced some measures locally, I still think that you're going to see that being a big weight on the economic outlook going forward.
What specifically rises to the level of being a risk that should alarm investors about the housing sector and what's going on there? I mean, we hear a lot of these reports about, kind of housing speculation going in reverse and, mortgage strikes. I mean, a lot of news out of there. Wondering what you think we should infer from it all.
Well, I think the question is, the housing problems are structural, and it's a big part of the economy. So, every 0.5% decline in the property sector, the real estate sector takes, about as much, even slightly more off of China's GDP growth. And it's about 20% of investment. If you take a look at household wealth, housing is as much as 60% of household wealth in the urban areas. So you have the mortgage suspensions, but you also have that we've taken up the default rate on China high yield property as well after having a very high default rate last year. And we continue to see that this is one where the local governments are taking more of a role. The central government's been very clear that, housing is for living, not speculation. So they've left this with the local governments. And we've seen the revenue from sales is down actually 35%. And what the local governments have been able to announce, they announced one local emergency fund. We think that will only cover about 12% of some of the losses that are being suffered right now. So they really have to balance this with respect to the overall sentiment for the upper middle class, just given how much of the household wealth is held in housing prices and property.
This happens at a time when China is, to some degree, out of step with the rest of the world in terms of where they are in their cycle, right? They haven't had a real full reopening. Their central bank now cutting rates. The rest of the world is in hiking mode. Also, inflation is not really kind of the central issue with that economy. Are all those things helpful to the rest of the world economy in the sense that they're offsets, or is it a real concern that they're not going to be contributing much to world growth?
I think that there's still a lot of market participants who think, well, China can come in and save the day and do a big stimulus package. But I don't really see anything like that being on the cards. I think China is at a different point in the cycle, and they can provide more fiscal support, a little bit more policy easing. But we're looking at China going into a lower growth trajectory, in large part because of their demographics over the medium to longer term. And the problems that they are facing are structural. It's not just the housing sector. It's also the youth unemployment rate, which is in the high teens right now for those who are under 25 years old. And you've got, very low birth rate in China as well. So I think that, the concerns about China are not going to go away. And the boost it's going to be able to provide to the rest of the world is a lot less than what we've seen when they've done stimulus packages in the past.
Yeah, does seem to be something of a different playbook right now. Joyce, appreciate you walking through it with us. Thank you.
Thank you so much. Great to be with you.